Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. One of the things that every product company needs to worry about is inventory. You have to have inventory to be able to sell goods to customers, but you also don't want to have too much inventory so that you have to eventually discount or cut back on production in the future. For every company that makes a physical good, this is a balancing act that's really challenging to do well. And one of the things that I've noticed with Tesla over the last 3 or 4 quarters in particular is that inventory is becoming a much bigger problem than it's ever been. So I want to dig into exactly what's happening, how Tesla is responding, and then what Tesla's inventory looks like compared to some of their competitors. My name is Travis William. Thanks for watching Rive Investing. Please subscribe here on YouTube for all my content. And let's get to the first chart that I want to show. That is Tesla's inventory level. It's pretty easy to see right here that inventory has become a much bigger challenge in the last 3 or 4 quarters than it was in previous years. Now, Tesla is trying to grow their supply by 50% a year. That's something that Elon Musk has stated over and over again over the last few years and does not seem to be backing down. The challenge is if you can't sell all that inventory, then it starts to either sit on your balance sheet or you have to reduce prices to try to move it through the system. It looks like both things are happening at Tesla. We know that Tesla is reducing the prices of most of its products. That's been happening since December, but inventory is on the rise as well. One of the reasons to worry about this is if we look at the cash balance. If inventory is building, that means that there's not as much cash on the balance sheet. You can either sell those goods and turn that inventory into cash, or you're using cash to build inventory. So since the beginning of 2021, you can see that Tesla's cash level is actually on the decline as inventory rises. This is not the trend that you want to see, although Tesla needs to balance the growth that it wants to have and the amount of inventory. So not necessarily a red flag by itself, but something that absolutely should be noted, because if the inventory challenge keeps getting worse, cash is going to go down. And that's when you start to see real challenges, because then you have to start moving that inventory through the system, reducing prices, reducing margins, reducing profitability. And we're already starting to see some of those factors at Tesla. One of the things I think is really interesting is Tesla's inventory level compared to its competitors. This is a chart showing Tesla's inventory versus General Motors and Ford. Now, both GM and Ford have dealers, and dealers have their own inventory. So there's a little bit of a buffer there between the automaker themselves and the customer. When there's too much demand, that can be a bad thing because you're not able to turn inventory into cash. But when demand starts to fall and supply is now starting to rise, that creates a buffer between the automaker and the end customer, because inventory can build at that dealer and it's not sitting on the automaker's balance sheet. So in a lot of ways, the dealers are a challenge for the legacy automakers, but when it comes to inventory, they're actually an advantage. And that's exactly what we're seeing here. Both GM and Ford make more vehicles than Tesla, but they have fewer days of sales in inventory. So that's what this number is right here. Tesla has about 3 months worth of sales in inventory, whereas a lot of the other automakers are more like a little over a month. Now, inventory is a big category. That can be raw materials inventory. It doesn't have to be finished goods, but it's just a proxy that we look at to see if inventory is starting to become a problem or not, because that can be like a canary in the coal mine for these automakers. Start to build too much inventory, and the next thing to go is margins. The real challenge for Tesla is the company wants to grow its supply by 50% a year. To grow supply by 50% a year, you have to grow demand by 50% a year. If that demand doesn't keep up, what ends up happening is you build inventory and eventually you get to a really troubling point. And I think we might be there with Tesla already, that you don't have enough demand to sell all the product that you're making. So you only have a couple of choices: either cut back on supply. That doesn't seem to be something that Tesla wants to do, or you reduce prices and reduce margins as a result. That does seem to be the path that Tesla is going down. We've even heard recently they're going to start advertising, trying to drum up more demand. So they're trying to move more product on the demand side rather than deal with the supply side. Look for this to be something that investors are going to be very focused on in the future, because if Tesla continues to build out inventory, that cash level that was once a giant strength for the company, because remember, Tesla has a net cash balance on its balance sheet. That cash balance is not going to be quite the strength that it once was. So this is something to keep an eye on. And it's really something to keep an eye on at any consumer goods product company, any company making physical products. Want to keep an eye on inventory. And I think this first chart that I showed here is really telling as to what's going on with Tesla. What do you think about Tesla's inventory? Leave those comments in the comment section below. Don't forget to follow Rive Investing. Thanks for watching, everybody. See you here next time.